of ag tech investment, sort of the underpinning of the theme. We'll cover a few broader things as well. I think maybe context, which is relevant to this group in terms of before my background with FCC. I've been with the organization about 18 months or so. I joined as part of the team to help launch FCC Capital. We'll talk a little bit about that in a second. Before that, I was part of the team that launched Silicon Valley Bank in Canada. So I had the opportunity to spend a lot of time in the universe of BC. And I led, in addition to helping launch the organization in the country, I also had the opportunity to lead two particular practices which are relevant to this audience. So the first was our climate tech and sustainability practice nationally, which included ag tech. So work with a bunch of our favorite Canadian VC-backed ag tech companies. The second was our frontier tech division, which was all of our hard tech, deep tech, so tons of robotics. So I had the opportunity with working a lot with robotics. So again, you can see why these two worlds have a tendency to meet. Before SCB, I had about a decade of clean energy project finance stuff, including 5-ish years of developing and building anaerobic digestion systems, primarily in the dairy sector. So nice to sort of come full circle back to innovation in the ag sector. So I think that maybe the common thread here, which is relevant perhaps to this audience, is I've had the opportunity to spend a lot of time either investing, lending, or working with entrepreneurs who are trying to finance hard things, sort of the gist. And so I just want to give you that background. So today I got a presentation. As I'm about to share my screen, you're going to realize that it has the date of when I was originally going to present, which is in May. So don't worry, the rest of it's pretty up to date. I hope. Let's see if this works. Is that coming through?
Yes, you are good to go.
All right, perfect. Okay. So before we jump in, there's a couple of things I wanted to do. So because I now have the mic and I like mics, I'm going to do the benefit of sharing all of you what we're up to at FCC. So you get to listen to my, I have two roles, right? Strategic finance and business development. So the first 5 or 10 minutes is going to be the business development section of this presentation. But I think it's relevant because you guys may have seen a few weeks ago, we made a subtle announcement about having a couple of dollars that we're looking to invest into the innovation ecosystem. So I do want to contextualize, for those who aren't familiar with Farm Credit Canada, who we are, what we're up to on the FCC capital side, because it definitely dovetails into the broader narrative about the investment landscape. Okay, yes, FCC is a Crown corporation 100% focused on providing capital and value creation to the Canadian food and agriculture industry. With FCC, these are big numbers. The short version is we're primarily a senior lender as an organization, established in the late 50s with the pretense of being foundational financing for the Canadian agriculture sector. And so over the last 65 years have grown. We've got about a $57 billion loan portfolio currently. Over 80% of that is primary agriculture. So think farmland lending, tractors, barns, quota, whatever it might be. And then the balance is our corporate and commercial lending. So that's agri-food and agribusiness, basically either side of the farm gate. That's a really important context in the context of this presentation, because the food system creates pushes and pulls that benefit agriculture, primary agriculture, and FCC, our mandate covers the entirety of that. We've got over 100,000 customers. I think like 95,000 of those are actually primary producers. For context, there's about 180,000 primary producers in Canada. I think we're at 2,700 employees in 100 locations. We've got 103 offices all over the place. So the national presence piece is relevant because we are the benefactors at FCC Capital of having insane surface area. So as an organization, not only is there an incredible depth of expertise, knowledge, but there's also amazing connectivity across every reach of the sectors of agriculture in the different regions. So this is FCC at a snapshot. So FCC Capital. So maybe we'll give the 30-second history would be FCC about 10 years ago started dabbling in what we'll call broadly venture capital. By providing limited partnership investments, so investments into funds. And so over about a 10-year period or so, built that up. I think we had about 18 fund investments, maybe $500-ish million committed across a variety of strategies. I'll show you what those funds look like. And so FCC had been dabbling, is the best way to say it, and kind of been dabbling passively. With our new leadership, Justine Hendricks coming in as CEO, and I think as everyone in this call would recognize, there was an insane opportunity. Insane opportunity in the. Oh, we got
It's another meeting.
I'm gonna mute Caesar. I'm gonna cut you it. There's an insane opportunity for innovation in and across the agriculture sector. And so I think the genesis, of course, of FCC Capital was Justine saying, let's go do more. So we established this team in April of 2024, which was really with the objective of expanding FCC's role in this ecosystem and being far more proactive and strategic. And so what that really meant, less words, more slides, is expanding the capital solutions that we provide. So again, FCC for 60 years, our capital solution was basically senior term lending, right? On the equity side, we'd already been doing indirect investing, so us providing capital to venture funds to then deploy in their given strategy. We wanted to be more strategic and proactive in that respect. We also stood up the capability to do direct investing, where FCC would directly take ownership stakes in companies. And then about 3 or 4 months ago, I had the privilege of launching our strategic finance team. And the relevance of that is if you get an organization comfortable with equity risk, ownership style risk, and you're a giant lender, you can put those two things together. You have venture debt, mezzanine financing, convertible debt of those natures. So we're on the journey of building out this suite of capital solutions that meet the different needs of the market. Early innings, but off to a pretty good start. The other piece of the equation is value creation. So FCC is a uniquely strategic organization in the Canadian and arguably global food ecosystem. And so we look at the opportunity to say, yeah, we can write a check, but as a strategic organization, the silliest thing we can do is to write a check, sit back and just be like, I hope that goes well. That's not good for anybody. Whereas because we have the benefit of incredible depth of expertise, connectivity, data, we have our innovation farm network. If we can activate those things alongside these new forms of capital solutions for the market, the intention is 1 + 1 equals, to quote my friend Joe Dales, 11. And he's terrible at math, but I think that's a good analogy. So, and so this is what we're trying to build. And again, I'll say a couple things. FCC's been around 60 years. We've been dabbling in venture for about 10 years. FCC Capital is like, what's that, 15 months old? Still in build mode. Lots of learning still going on. So we are building the plane as we fly it. We were proud to have done in our first year of existence over $170 million of direct investments, which anyone who's launched a venture fund can attest. That is a hell of a lift, but lots more to go. So that's maybe setting the stage for FCC Capital. Yeah. Some highlights. We've got 22 funds now, 650 million committed. The relevance of the fund strategy is we're a team of 9 people. Well, the investments team is 9 people writing checks. There's no world that, so the announcement was we have $2 billion allocated to invest in the sector. There's no world 9 people can deploy all that capital and solve all the market's needs. So we need to work with other investors and back them with their strategies to cover the entire sector, all stages, et cetera. And so this indirect fund investing is critical. We're already, as a result of that strategy, we already are indirect owners of over 100 Canadian ag tech and agri-food businesses, just through our fund investments. Direct investments, we talked about that, as I mentioned. A couple of 2 things for this audience that might be helpful. One, we're shooting for at least a $5 million check. So we're going to more likely catch those companies that are showing escape velocity and give the full strength of our balance sheet. And the second thing, we're not set up to lead investments. So our objective primarily at this stage is to catalyze alongside another lead investor. As I mentioned, first direct deal was last summer. We ended up closing, I think we ended up getting to 10 by the end of March. So off to the races. And then I talked a little bit about strategic finance, which is basically higher risk lending. I'm going to skim over this. We can come back to this audience if you're interested in scratching a bit deeper in terms of the ways that we're supporting the ecosystem to provide more opportunities for entrepreneurs and more importantly for growers to gain. So entrepreneurs to build better businesses, growers to gain better access to innovation. A few logos that were fun that we're invested in. This won't shock anybody. This is probably all or most of them in Canada. And so the intention here is we've got a variety of partners who can cover more of the market than we ever could on our own. Okay, so that was the business development section. Hopefully now you're just a little bit more informed about what we're up to at FCC. Can talk a bit more at the end. Okay, so we're going to talk about the state of the ag tech venture capital ecosystem. And before I dive in, there's a couple of caveats I want to set up. So the first is venture capital isn't for everyone or everything at all. This is not to say that's a panacea that solves all capital needs for the market at all. However, that market is huge and has a lot of data. So it's a very good proxy to how capital is flowing within the innovation ecosystem, even if that particular type of capital isn't the perfect need for you right now. So a lot of what we'll talk about is super focused on the venture capital ecosystem, but imagine it to be a good indicator of broad capital flows for this sector, even if that particular check isn't the one that may be relevant for you. The second thing is the US, a lot of the data we'll talk through is US, because US represents about 50% of the global venture capital market. It therefore is the leading indicator of most of the other markets. It's got the biggest depth of data. So if you're going to derive insights, it's most likely you're going to see them coming out of the US market. And the third thing is capital flows across borders. And so what's happening in the US or Canada, investors in Canada invest in US companies. Investors in the US invest in Canadian companies and globally. And so you're not competing for capital based on who's the best company in Saskatchewan. You're based on who's the best company in the world, because that's how capital is flowing. And so I do think it's important to sort of have that broader macro perspective when you think about capital. Those are caveats. I also want to talk about all of venture capital, not just ag tech, because investors can pick whichever sector they want to invest in. And so understanding the benchmarks and what good looks like and how capital is flowing across the entirety of the market is very important context within the subset that is ag tech. So the first slide I wanted to share was a long-term view. Because if you see headlines, we'll talk about sort of general trends, but if you see headlines, you'd be like, it's over, venture capital's over. Because most of the charts start at 2021. If anyone's keeping tabs, 2021 was a slight anomaly year. And so what I'd like to call out on this slide is when you take a long time view, yes, it is down relative to the insane, completely unreasonable high that was 2021, but it's historically high. So 2024 ended up being more capital was deployed in venture capital in the tech and innovation ecosystem than in 16 of the last 20 years. So what we're seeing is, yes, it is low relative to 4 years ago, which is an absolute outlier, but historically high. This is going to be a theme we come back to quite a bit. The other thing is that this is from a slide from the SUB State of the Markets report in 2024. 2024 actually ended up being more robust. We'll see that data in a second. Okay, so this is US all venture capital DL activity, quarter over quarter from 2021 to 2025. Remember what I said, 2021, total outlier. If you may notice, Q1 2025 actually was in line with 2021 capital flows. So in all of 2024, $213 billion was invested in venture capital in the US. 91 billion was invested in Q1 alone. I don't have Q2 data yet. So I think what is an important takeaway here is like, oh, it is a more robust venture capital market perhaps overall. Now, yes, if you were to divide this out, it's like 65% generative AI. I'm not kidding. It's going to be order of magnitude, something to the degree of that. But the point is venture capital as a source of capital has not dried up. There's nearly $400 billion of dry powder in venture capital funds sitting on the sidelines currently. It's not just going to get returned to LPs. It's going to be deployed. The question is where. So then you say, well, what's happened? Who's getting the money? So we talked about generative AI. So when you see so this is the rank of VC investment by tech subsectors in terms of year-over-year change. That green bar is the one this audience is probably interested in. Frontier tech is hardware tech. Note, it has increased 50% from 2022 to 2024. The only other sector that increased anywhere near as high was enterprise software, which was generative AI. This is on a relative increase basis. Frontier Tech is less capital. Don't get me wrong. It's a lower starting point. But the point is interest in Frontier Tech, which typically has far, far more differentiated intellectual property, has meaningfully increased. Because the froth is off on undifferentiated business is the Coles notes. And if you have differentiated IP embedded in hardware, you have a clear differentiation. It doesn't make it easy, but you've seen capital has flown that. Okay, so Canada. Now, a lot of folks might have seen this chart, made its rounds of LinkedIn, along with headlines like VC is dead in Canada. You know, what are we doing? The market's failing. Yeah, it's challenges. I'm not saying it's easy. But in 2024, as you can see here, there was $8.5 billion invested in the Canadian venture capital market. If we went back 2 more years on this chart, 2019 was 6.1 billion, and that was the all-time record for Canadian venture capital invested, 6.1 billion. So again, perspective, right? We're over a third more than the all-time record in 2019 in terms of capital invested in venture capital markets. My point is not there, oh my God, it's all hype. Everything's perfect. My point is capital is flowing. I'm going to punchline at the end. We're going to talk about where it's flowing, which is a really important question as you think about where investors are deploying their capital. But I think the narrative here, again, is the longer term purview is really important in terms of understanding where the capital is flowing. Now, a challenge for the benefit of this audience is so institutional capital flowing into funds, that is slowing. So we do have a leading concern, which is we're not seeing funds being able to re-up and get more capital. So this is indicative of capital has been flowing, but I will say is that in the Canadian market, there are leading indicators that the funds that are going out to raise their next fund, they are struggling to get access to limited partner capital. That is a real concern long term. So I'm not going to minimize that. I hate this chart, but I'm going to show this chart. And I want everyone just to first say, you see agribusiness at the bottom? It's pathetic, but it's also wrong. Okay, so this is from CBCA. Nothing against CBCA. You got to, however you slice and dice data is important. So this will tell you that in Q1 of 2025, there was 4 transactions totaling $12 million. That's, for all intents and purposes, that's zero. Why that's happening is because a lot of the businesses we call ag tech or food tech fit into clean tech, life sciences, and ICT. So the challenge for everyone to be aware of is if you talk to an investor, you go and you have the opportunity to talk to a capital allocator, a pension fund, they pull up the CBCA report and they look, they're like, why would I invest in a sector that only saw 4 deals and deployed $12 million? So the narrative for this audience, and this is something I preach a lot, is because some of the best companies that we think of as ag tech don't get tagged in agribusiness. And this is relevant. This isn't just one chart. This is the Canadian Venture Capital Association's report. And their methodology always shows extremely small numbers in agribusiness. So folks on this call who presumably want to evangelize the importance of innovation across agriculture is know the data, and how you'd be tagged is probably not an agribusiness. You're going to hate this chart, but it's important to show because it gets brought up a lot. Okay, so that's general, right? That's general tech, broadly speaking. I want to talk specifically about the global ag tech investment ecosystem. And again, there's sort of subtleties and nuances to this that I want to pull out. Again, so this is a lot of the charts you'll see start at 2021. And if you start at 2021, oh my God, the sky is falling. But if you look at this chart on a longer term basis, 2024 was a record year after 2019 in terms of global ag tech investments. So again, the point isn't, oh, it's all rosy, but the point is on a longer term basis, there is still a high degree of capital flowing relative to what was flowing previously. Think about some of the incredible businesses that were built before 2019 that had incredible exits. So yes, harder than it was to get capital in 2021 and 2022, but there's still lots of checks being written. Interesting observation. This is a mix of the VC deal value. So I alluded at the onset to the importance of having a global mindset. It's because capital flows 2014, 2015, highly dominated. 70% were coming from the US. We're seeing now that's maybe half. Huge extension from Asia, huge extension from Europe. And so Again, because food is global. It is so global. And there are other jurisdictions that disproportionately have an interest in seeing innovation advanced. So if you have a high population and small land mass where you can't grow a lot of food, you're probably really interested in writing checks into technologies or getting access to supply chains that benefit your population. This is a narrative that I think a lot of folks in this call will be familiar with, but is a critical one. This is, again, like, yes, the Canadian venture capital ecosystem needs to be more robust. 2 thumbs up, we're going to step up and do our part. But don't lose sight to the fact that this is a global market with global opportunity and global investors who have disproportionate interest in what we're building. Okay, I want to talk a little bit about trends in terms of deal values and valuation. So again, a lot of this is in ag tech specifically. There are a lot of interesting charts if you look at the trends in terms of deal sizes, deal value, valuation across all of tech. Like from 2021 high to 2023, fintech valuations dropped about 92%, just to give like sort of as a proxy. So we look at ag tech, a couple of things are interesting. One, they've actually both deal size, median deal size, and the pre-money valuation has actually been pretty solid, relatively speaking. And we've seen an uptick in 2024. So 2 observations. More often you're seeing differentiated IP in ag tech. So the underlying strategy, the underlying thesis is somewhat buoyed regardless of shorter term trends. So it's often the case in frontier tech and deep tech as well, as you sort of see it ride the waves, the hype curves a little bit better. The second thing is we're starting to see an uptick in valuation. Now there's a dynamic here, which is, we'll get to, is where that capital is flowing. I mentioned capital still flowing. It is flowing to stronger companies. So the dynamic is there is more there's more money going to the stronger companies. We're going to talk about what stronger companies look like in a sec. So what that means is, the median valuation is higher because all of the money is going to the top 25th percentile. It's a really hard time to be in that muddy middle, and it's an impossible time if you're in the bottom 25th percentile. Again, we'll talk about that in a sec too. So again, there is reason to be optimistic. Capital is flowing, valuations are strong, deal values are actually up. But it's skewing towards those who are meeting the benchmark for what good looks like today, not what good looked like in 2021. Within global ag tech, again, as you guys know this very well, there's a huge bucket. People are like, I invest in ag tech. I'm like, well, that's 30 different segments, depending on how you want to carve it up. So what's interesting is in terms of what we're seeing, this is from 2024, this is 2024 data, maybe actually up until Q1 of 25. The division, indoor farming cooled off quite a bit, probably to no surprise to a lot of folks. Ag biotech and precision ag biotech in particular, very IP differentiated businesses, and precision ag, again, we're seeing those with more IP differentiation. So like general operating system software, those who have real differentiated AI embedded solutions as an example, you're seeing that have an uptick. So again, you're seeing almost 70% of the transactions are between ag, biotech, and precision ag. So indicative of the segments that capital is flowing to. And again, this is venture capital. I'll make the point I made before. Even if venture capital is not right for you, for your business, for your stage, this is indicative of where capital flows are going. Okay, so this is global VC markets based on upstream, midstream, and downstream. Downstream being sort of right down to retail. And so since the peak in 2021, this is by dollar value of investment. There's been an 85% decrease in downstream, right? Like right down toward the retail end. So think of like, this could be everything from last mile delivery, et cetera. Upstream's only seen 41%. So yeah, even since 2021, that peak, we've seen that decrease. But upstream, where you're seeing really servicing the farm, that has been far more resilient, particularly as it relates to crop inputs. Okay, so that's interesting. Again, that segmentation tells you a different story as opposed to this broad bucket of what's happening in ag tech. The second, this is by deal count, right? So I'm going to flash back really quickly. So we see an 85% decrease in the downstream capital and a 41% decrease in the upstream capital. But this is by deal. So we're seeing a 50% decrease in the deal count downstream and only 29% decrease. And this is from the 2021 peak, right? Decrease in the upstream. So what that tells you is more deals are still getting done, right? Like we're not seeing the same precipitous drop, even from 2021 peak in the number of deals. And everyone on this call will tell you a $6 million round is still better than not getting, like 10 might have been the target, but you'd probably be okay operating with a $6 million round. So that 40% reduction shows up in the overall VC capital flows, right? You see that number drop, but the number of deals, the deals to make it done. And so I think it's, again, it's the distinction is what, like getting a transaction done is a critical element to capitalizing the business, even if it's with a different dollar amount. Okay, so this is sort of the macro stuff. One of the things I want to spend some time talking about, as I mentioned before, is capital is flowing. Who is it flowing to? What are the profiles that are able to attract capital is so important. Because again, if you're going to go raise capital from anybody, you're not competing with the best in Southwestern Ontario. You're not competing with the best only in Saskatchewan. You're competing with the best globally. Full stop. So you need to know what good looks like and how you compare and how you might think about when you're going to be ready to raise the next equity round if you want to go to the VC and how that might correlate to valuations. Okay, this is, and I will caveat, this is not ag tech on purpose, to the point of investors can invest in any category they want. And so if you're comparing yourself as an enterprise software company or robotics company in ag, they can invest in robotics and ag, manufacturing, humanoid robotics, they can invest in anything they want. And so understanding what those benchmarks are is really important, independently of the subsector. Okay, so the first on the left is the median revenue growth rate at the time of the round. So quick first, revenue growth has declined across all venture-backed businesses. This is a function of broader macroeconomic factors where we're just not seeing the adoption rates as high. And we've seen companies scale back the growth at all costs. Double factor, right? Sort of folks more focused on margins. But when you look at Series A companies at 2021 saw a growth of 160% year over year, median growth rate. That rate has declined meaningfully by 2024, and they've all consolidated between Series A, Series B, and Series C. But the median growth rate is still between 60 and 80% year over year is median. So if you're growing 20% year over year, you're not getting venture capital. If you're growing 120% year over year, you probably got a very attractive story. This is there's a bunch of narratives baked in here, as I said. It's both margin, focus on margins, not growth at all costs, but you're still expected to have a very high growth rate, even through growth stage. The piece on growth stage I'll just pull out as well. The fact that the growth rate is still so high at a Series C is a testament to the fact that capital is flowing to companies who can show they can still grow at scale. Which is, again, capital is following the winners. It's a flight to safety, you hear that narrative. So on the right side is what is the median revenue? This is really important. This is US dollars, all VC-backed companies. So if you're going to go raise a Series A, the median revenue is $2.5 million US dollars. That's what $3.5, $4 million cap. That's up 75% from 2021. So the benchmark of commercial traction to raise a Series A is up 75% from 2021. This is a really important data point in my mind, because there's a lot of seed stage companies in Canada that are like, let's go raise our Series A with like, $1.5 million CAD of ARR. Okay, you're not going to raise a Series A. Sorry, it's going to be really hard because the market wants you to have 4. And so you see that staggers a little bit as you get further on. I mean, even still, thinking about a Series B is to raise a Series B, $6 million US. And it's 88-ish million revenue Canadian. And so I think this is really important. When you think about like what a good Series A company, a good Series B company looks like, that is what the market is rewarding. That is the median. Okay, then let's go on the other side in terms of burn. Again, I'll repeat again, venture capital is not for everybody, but in this model, the intention is you are a cash burning company where you're prioritizing growth, technology development, product development over necessarily solving for EBITDA as fast as possible. Not the right answer for everyone, not a model I advocate for everyone, but it is helpful if you are in that profile, even over the short term. What is a reasonable burn mark? Again, this is median based on revenue level. So for those companies who have $1 million in revenue, the median burn is dropped a lot since 2021 peak, but it's still at like 300% of revenue. So you're burning $3 million in that year that you did $1 million in revenue. The point of that is how much are global venture capital backed companies investing in their growth? That's the way to think of it. You see that number declines over time as you'd expect. Even if you're doing 2.5 million. So again, go back to the Series A. Series A company, 2.5 million in revenue, ready to go raise that Series A. The median is burning 171%. So again, probably burning almost, call it like $4-ish million for that year that it did 2.5 million in top line. Again, I'm not advocating, don't go out and burn capital. But if you're raising venture capital, that's the degree of capital that they're thinking of to drive that kind of growth. All tech, not ag tech, all tech. So you'll see different ratios, different things make different sense in terms of different subsectors. But this is a good proxy as you think about how much folks are investing to drive that top line to get to their next round. Okay, I'm going to end because I'd love to do Q&A. I don't know, actually, we've probably got 5 minutes for Q&A. So the takeaways I want. First, yes, VC markets are tough. They're always tough. Like VCs look at 100 deals to do 1 check. It's always a savage industry, which is ruthless. But it is still historically strong, and there is cause for optimistic outlook, particularly for those businesses that are IP differentiated. The second is it is a global benchmark. Again, this is not about being the champion of your own backyard. And if you want to attract the strongest capital in Canada, in North America, globally, you got to know how you compare against the rest of the world. Third, venture capital is not for everybody. And this is not me advocating or preaching the VC model. It's just, if this is an avenue you're going, this is the data you should know. And generally speaking, attracting capital, this is an irrelevant data set because of the amount of capital that flows here. Fourth, companies are not going to make it. And that's okay. It's okay that some companies are going to run out of money. The worst outcome is they run into a brick wall blind. The best outcome is they say, I'm not going to meet these benchmarks. I'm not going to be raised capital, and I'm not going to be able to get profitable quick enough. The question then is, what do you want to do with your team? What do you want to do with your IP? Plan on the opportunity to join another team, take that expertise you learned, transfer it into another organization. Canada needs to build a flywheel of entrepreneurs who have built and failed, built and failed, built and then succeeded. The fifth, which is the most important, and we are preaching this at every single level we get the chance at FCC, is the macro thesis for agriculture and food. Innovation in agriculture and food is stronger than ever and is one of the most compelling on planet Earth. We need 50% more food between now and 2050. Sorry, 40% now. We're doing it with more or less the same amount of arable land, facing the pressures from drought, flooding, soil erosion, and we need to do it ideally with less inputs on an absolute basis, but certainly on a relative basis. So when you need 40 to 50% more of something, which is an essential good, with the same or less inputs, you can singularly solve that problem with innovation. That's it. That's the only way you solve that problem. And then you look at the global market. Agriculture is a $4 to $5 trillion a year market, and the food market's 15 trillion. You say, oh my God, we must have innovation for this $15 trillion a year market. There must be capital flowing like crazy. It's like, oh, it's still relatively underrepresented in the general capital flows. Hence why, for proactive investors, that is an incredible thesis. So again, our job at FCC is not only to write checks, but to catalyze more folks coming around, make it easier for them to write checks, and help drive bigger successes. Anyway, so I'm going to pull this down. If I can, that works. No.
Awesome. Thanks, Graeme. And we have had a few questions come through on the chat, so I will start with those two first, and then we can kind of loop into anybody that's got a raised hand. If you have not raised your hand before on Zoom, just a quick note, it is the react button with the heart on it, and then there's the option to raise your hand. So again, a quick thank you again for your presentation. Very informative. And I see Tim has been putting in little talking points from your presentation as well. So those are helpful, Tim. Thank you. So we're going to go right into the questions. First off, Sandra has asked, I'm not sure if this is specific to your position or not, but would things like precision fermentation be considered ag biotech?
Yes. Probably walks into the food tech universe, but semantics to a degree, but yes, it is.
All right. Next, Matt Stevens from Finite Farms has asked, do you have a sense of the investment breakdown by crop type, grain versus dairy versus horticulture, et cetera?
Great question. I don't. Gut would say grain just because like Broadacre gets a disproportionate amount of capital. I think technology was an interesting one as an aside. I would argue that that is probably the hardest place to commercialize your technology for a variety of reasons. You've got higher seasonality, you've got lower margin industries. I would love to see more capital flows and more tech development for those industries which have less seasonality, more cycles to test and iterate. Like, where's our chicken tech at, right? You got like a 35-day cycle time. My also thesis is a lot of chicken farmers are also crop farmers. And if they have success on the chicken side, $5 says they're better adopters of innovation on the crop side. So as a bit of an aside, I think it's disproportionately skewed towards Broadacre. I think there's an opportunity to drive shorter term, faster successes, which is good for everybody, not just the adopter, but for the industry within anything which is 4-season food production.
Okay. I will throw out too, we have a poultry show in February that it would be great to have that conversation with those folks too, because that would be maybe somewhere we can kickstart that conversation. It's the first week in February and it's in London. So I will follow up with you outside of this call. Sandra has asked, do you have a view of what makes a strong seed investment? Is it differentiated IP, pilots, partnerships with potential future clients?
I do. I would say, let me maybe walk through just because it's semantics about describing what raise is. So like pre-seed is, I got an idea. I want to see if it's like I can make it work in a pilot stage. Seed stage is I got my first like semi-commercial customers that I want to like do my first couple, like prove that I'm going to have early product market fit. And Series A is I've got early product market fit. My fire, like if seed is like putting the kindling together and trying to light the fire, Series A is like, oh my God, it's smoking. I got a little bit of flames. Can I have a little bit more fuel to pour on my fire, please, to see if I can grow it on the basis of how I've been established in the business. So with that in mind, I think that it's having a clear first commercialization strategy to test. So differentiated IP always, I'll say patents aren't worth anything. You know how many patents sit on a shelf that aren't like, it's can you commercialize it? So the test is IP simply provides you with a defensible moat, which is only worth it if people pay for it. And so the seed stage has to be demonstrating that someone is conceptually willing to at least use your IP and ideally pay for your IP.
Excellent. Yeah, that's a good differentiation. Tim, I'm just going to go to you quickly because I see you've thrown a few things in the chat, but I'm not sure if it's a question.
Yeah, actually, I do have a question, Graeme. Always appreciate your insight. Thank you for that one. You mentioned earlier that there's a lot of foreign investment coming into the Canadian ecosystem. Does this mean that there's a threat to Canadian food sovereignty in this case?
Not necessarily. I mean, there's a difference between investing in innovation and investing in farmland. So that's one. Okay. I think there's also a difference between like, so I don't view it as a threat, broadly speaking. It's interesting when we talk about capital flows is sometimes FDI is celebrated and sometimes it's sort of lauded, right? It's like, it depends on the context, I suppose. Canada is not, ag is interesting because Canada actually is quite an outsized player in agriculture in terms of as a market size, but generally speaking, Canada's not a huge market for most companies to build and scale in. And so most Canadian entrepreneurs are born exporters. The best way to get access to some of those markets is generally through investors who have understanding of it. Not always, but that's a good pathway. So again, it depends on who the check writer is. I would say Canada is certainly at this moment in time, like the fact that Temasek is knocking on doors pretty often. I'm like, yeah, Asia's an enormous market for us. We're seeing a lot of the Middle Eastern sovereign wealth funds are like, hey, we need a lot more food. Who can help us give it? Right? Who can help us get it? And so broad strokes, I would say it's net good.
Okay.
And again, I think that yes, there should be nationalism, but I mean, that takes a number of years to fully build up, and it's not going to be in the benefit of isolationism, I don't think.
Right. Okay. Thanks, Graeme.
Joe, I see your hand is up. Is your question in relation to this?
Question for Graeme?
Yep.
Yeah. Thanks, Graeme. People that don't know, Graeme's been tremendous champion for bringing technology and venture capital together in ag and food with FCC. So thanks for sharing today, and thanks for all your good work and leadership. A couple of questions for you. Can you talk a little bit? I know we're going to have Chelsea go into it in more depth, but the whole innovation farm concept on how your vision is to support the ag tech investments and get traction faster and get innovation into farmers' hands quicker.
Yeah, great question, Joe. Chelsea will probably give more detail. I'm going to try to go succinct in the context of this conversation. So first I'll say there's never a shortage of capital, but there might be a shortage of customers. Show me the customers, I'll show you the capital, right? So that's version one in the lens of like attracting capital. Lens two is all of this is a waste if it's not adopted. So adoption is everything. You see the link between customers, commercialization, adoption. And so when we talk a lot about we need to, make better entrepreneurs, support entrepreneurs, help you make the best business possible, that is one side of the equation. On the other side of the equation, we also need to help growers be better adopters of technology. And so how do you do that? Well, the first thing you do is familiarity and overlap. And so the Innovation Farm Network that FCC funds, so we've got 4 partnerships covering now at 7 locations. And I think we're at like 16,000 acres across Canada. It's intended to be a place not only for entrepreneurs to test, trial, and demonstrate their technology, sort of move further up the TRL scale. That's sort of the like IP development. But it's a natural, non-commercial environment for growers to get exposure to innovation in an environment that's relevant to them. This is really, really important because I think the number of pre-seed companies who buy a booth at an outdoor farm show and wave down farmers are like, buy my thing, and like no one's ready for that transaction. That's a very common way to try to commercialize a business. The Innovation Farm Network is meant to be a bit more of an organic, not like capital or organic, a bit more of a natural pathway for innovators and growers to interact with each other. And the example I give is the first time you saw a Tesla go by, you're probably like, what the hell is that? They made no noise. The second time you're like, I wonder how fast it can go. Third time you said, I wonder how much it costs. The fourth time you said, I wonder how many chargings. It takes a number of times to interact with innovation before you'd ever get to a purchasing decision. And that's really hard in ag tech. And so the innovation farms, in addition to demonstrating, trialing, and showcasing technology, it creates the opportunity to make better adopters of tech and innovation. So is that kind of, Joe, what you're hoping for?
That's perfect.
I can tell you more, but
yeah. Chelsea, go into it. Just noticed this week, Root AI from FCC, and is it RDAR in Alberta? You're launching an AI tool. Any thoughts or comments that you want to share? That's pretty new.
I don't know who's paying you to ask these questions, but they're fantastic, by the way. So thank you very much for throwing me some lob balls here. Yeah, super excited. So a lot of folks on the call will know that FCC owns, I think we say let's call it the largest ag tech software platform in Canada, Ag Expert. And so it's 25,000 users, 6.5 million acres, lots of data. We've owned it for 20 years. So that team, Ag Expert, launched Root, and I think we announced it a couple of days ago. And it is a generative AI tool for farmers to, in effect, ask anything. You take my combine broke down, take a picture of the part. How do I source this? Boom. You have the ability to say, hey, what would be the impact on this acreage of this crop input? Part of the ability is it can scour all data, like web data. It can scour FCC database, and it can scour your own farm's history. So that's today. It's now a platform that we can build in because we're in the process of building a digital twin. So you, as a farmer or user of ag expert, have put in your field data and accounting data. Important when those two come together as you think about financial decision making and profitability per acre. We can, or on the process of making a digital twin for that. So at the beginning of the season, you can run a variety of different scenarios in a digital version of your farm. And again, Root, you can ask it and interact with those versions. So you can be in the middle of the field and say like, hey, what if I did another pass of fertilizer? What happens? And so early innings, I'd say go play with it. It's publicly available. I'll find a link and check it in the chat here in a sec. But I think it's an illustration of how FCC is starting to kind of bridge together. We've got a ton of growers who use innovation. We've got a ton of data through Ag Expert. We want to start bringing tools in there. And I think the link, Joe, we've talked about this before. Ag Expert has a module in it called My Farm Connect. And My Farm Connect is basically an app store within Ag Expert. Because the last thing any farmer wants is another app, is another login, is another, desktop browser version. So this is the ability for us to have API connectivity to other platforms. We're starting with a lot of the big ones, as you can imagine, like plug into your Trimble and whatever.
Yeah.
But the premise is to be able to use that as a platform for more solutions to be on farm in a consolidated way.
Good job.
Awesome. Thank you for those questions, Joe. And just I'm keeping a little bit of an eye on the time. So just going back to one of the questions that had come through in the chat earlier, and then Ian, I will get to you. And then I think we might put it back to Graeme for just a quick wrap up. Sorry. Actually, I'm going to go to Ian first because I just lost the question as there was not more coming through. So Ian, I'll go to your question first and then I'll get that one from the chat.
So I played with your AI thing today and it's pretty good. I've only played with it a little bit.
Is it
Just
smarter
one
than
comment
you,
you
though,
made in
Ian?
terms of purchase decisions. I think we have to realize, and the present economy is changing things a little bit, but farmers make a lot of purchase decisions on emotion, not on the financial spreadsheets that they've created, because many of them don't have that. In fact, I would say most of them don't have that. And that's something that we have to think about. So, that little robot or whatever that we're trying to get them to buy, it needs to be attractive to them in terms of getting to their emotion in terms of that purchase decision. And it sounds silly, but it's very true when you ask farmers. So I think we need to keep that in mind.
Mm-hmm.
It's a great point, Ian, and related to that, we also, as I know Chuck has kind of done it a little bit with the robotic systems that he's already got on the Innovation Farm Network that FCC funds for us, but if there's all these startup companies that are coming out and they're all using different systems, how we can find a way to incorporate that so it is easier to input it into Ag Expert versus a farmer having to put that manual data in, because we know that they're not going to do that. So that's something I think that he's also looking at with the teleculture units that he has, as well as the Yuko Ag weather stations, is how you can have one system that's being used across multiple different sites and robots. Okay, so going back to that question, it was, what are the biggest challenges for ag tech startups today? Are they more technical, such as reaching higher TRLs, or non-technical funding, procurement, etc.?
Non-technical, commercial. Period.
Thank you.
There's an obsession in this country over IP and TRL and the grants that fund them. Important, foundational. That is a great place to start. We need to go to the next step, which is commercial. That's it. As early as humanly possible.
Excellent. And I will mention too, the Innovation Farm Network, I think Joe touched on it a little bit, but we can do an entire day that's separate on that. And if Graeme or Chelsea want to come back and bring in some more thoughts on that as well. So FCC does fund through the working group and our Innovation Farm Network, which is 4 sites in Ontario currently, as well as the sites that they have mentioned. There's a bunch of projects that we're doing to try to support this ecosystem. So that will be probably its own topic, just in essence of time. I'm going to jump quickly to Eric, because I know this is an event that was shared through the meeting invite, just trying to get it in front of everybody. So Eric, if you want to do a quick introduction about that, and then we will kind of wrap up for today.
Yeah, thanks a lot, Bridget. Appreciate it. So hi, everybody. I just want to bring up an event. Chatham-Kent Municipality reached out to me. Teresa Fish works for them. And we would like to invite everybody to an event in November 18th to try to draw in high school kids and kids studying at University of Ridgetown. So the reason why it's in November is because school's in session. We can get buses to Ridgetown, and then we can get high school age kids getting into this technology and try to promote it and bring them in when they're a little bit younger versus when they've already decided on a career path later on. So the event, I shared the PDF in the chat. Teresa is also on the call, and her contact info is on the letter. So if you're interested in participating, we're looking for anybody in the ag tech space. So it could be companies, anybody who's interested in ag tech can come and present, have a booth and do a demonstration. So I'll send out that invitation to companies that I think would be interested in this, like Haggerty Creek. But I'll if anybody's interested in it right now, I'll throw my email in the chat, and Teresa's is on the letter as well. Thanks a lot.
Awesome. Thank you, Eric. And it was in the agenda for this past week. Dan included it, and we can include it in next week's agenda as well. So if you are interested in that opportunity, please look into that. Okay, so going back, Graeme, if you're open to 2 more questions, we'll kind of end with that. And then if there is anybody else that had a roundtable question that didn't get the opportunity, please just send me a quick note. Jason, so Jason had asked, can you give an example profile of FCC's venture capital investments? Actually, I think you might have already touched on this in your presentation. So Jason, we might go back to that, but he'd asked specifically precision ag, biotech partnering investors, etc.
Yeah, I mean, our first investment was in Catalera Biosolutions out of Vancouver, which is biological crop input. And we did that. There's 2 reasons, there's a couple of reasons why. Great Canadian company, spun out of Terramera. Folks are familiar with some of the work they were doing. And also because we came in alongside S2G Investments, probably one of the most prolific global investors. And so again, we're not leading investments. We need an independent lead to price and structure around that allows us actually to move a lot quicker. We're not leading diligence. Trust me, that's a good way for us to deploy some capital alongside global experts. We can also catalyze by saying, if you guys will do X, we'll match it, and it makes a round much easier to close. So that was an example of Catalera. We also invested in everyone's favorite autonomous drone company, Precision AI. A lot of folks know Dan McCann. So as an example on the precision ag side. So more examples that we can play on. But I point those 2 out as probably illustrative of about as early as we'll go in terms of stage. Yeah, hopefully that's helpful.
Yes, that is helpful. Thank you. Marzan has asked, can FCC funding include project or products such as research or standards for the agricultural agri-food sector in Canada to have a direct impact on the adoption of ag tech?
Maybe this may not, I got probably 2 different answers for you, Marzan. So the first is clarifying is, so FCC capital is equity investments, right? Like, so not that this is what you were saying necessarily, but not grants ever. So we are not a grant provider. There's lots of folks who provide grants. And so generally speaking, we're looking at investing alongside commercial equity. Equity is typically funding as part of a whole round where, you know, projects and products advancement may be a component of that, but it's part of a broader business plan. So yes, if part of a broader capital raise, and again, with the caveat of we're typically looking at writing a $5 million check or larger for us to be direct. This is why we're investing in fund partners who can support typically, but not exclusively, the earlier stage. And then generally speaking, seeing that capital as part of a broader business plan as opposed to necessarily for a specific project.
Excellent. Hopefully that answered your question, Marzan. Teresa has just provided some information in the chat regarding the event that they're doing on the 18th. Okay, we have time for 1 more question, and then I think we'll be at the end for this meeting. I will, just before we get into that, say a big thank you again to Graeme for joining us today and for all that information. For those that are interested, so typically with the working group, we do publish a recording of all the meetings. Usually it's about 6 weeks after the meeting because we want you to come to the meeting, but that will be available up on our website, and Graeme has provided his contact information in the chat if you have a question outside of this call. Any additional 1 more question if there's anybody?
There was a question from Juliano in the chat that we didn't get to. No, Joe, that's where you're going. Joe.
Okay.
No, I can be super quick about it because it says you talk about the $2 billion fund announcement. Is there new money in this or just an amalgamation of existing funds? So it's new money. So it's $2 billion commitment. About half of that's focused on innovation, so IP differentiated business. So about $1 billion. Some of that will be allocated to funds, third-party funds. Some of that will be FCC direct investment, and that's an intention to deploy over the next 5 years. All of that is equity. So none of it's grants, all of it's equity. And it is net new.
Excellent. Thank you. All right. So one more also quick announcement. So as most of you know, we do have our demo day coming up, our next one coming up in Simcoe on July 22nd. This past week, we did have the demo day at the Bradford Ontario Crops Research Station. Just wanted to say a big thank you to everybody that participated and attended that, as well as the funders and sponsors. So again, I mentioned Graeme through FCC Ag Experts funds our Innovation Farm Network. So we'll have funding from that from now until 2028. And we also have funding from OMAFA for our working group. And then just more so on the detail side of things, for our lunch, we had STEM Minds as well as the University of Guelph sponsor that. So big thanks to those folks, as well as the folks at Smith Gardens for hosting us and the Muck Crops Research Station team. So big thank you to all those folks for their help with that day. Joe, was there one more announcement that you would want to throw in?
I just wanted to thank Graeme again. And then, Graeme, is there anything this group can do? There's a lot of stakeholders on here to support your efforts and success and initiatives. How can we help?
Well, I think you're doing it. The fact that you guys meet weekly and swap notes and are collaborative is good. I think one thing that I know I'll put a plug for hopefully a future session is bring in folks who have built businesses or are building businesses who are not in ag. I know that there's a conversation potentially around sanctuary AI joining as an example is, yes, ag is special, but people have built and learned a ton in sectors that are not ag. Bring them around the table. You're next to Kitchen Waterloo. Go get Matt Rendell from ClearPath Robotics. Go get Faizan from AvidBots. Go get them to tell their story. Learn what they learned. They built their businesses at scale. That'd be my ask. And I think as a result, stronger entrepreneurs, stronger businesses drive success.
Great idea. Thank you.
Fantastic.
Thank
Yes,
you.
thank you. And we will have ClearPath hopefully in the future because we have a call with them next week. So any other names you have, Graeme, just send them to Joe or myself, and we'll get them on the call.
Sounds good.
Excellent. Okay, we are at time. Thank you everybody for all of your questions this morning and for joining us. We look forward to seeing you next Friday. Again, big thank you to Graeme for joining us and your presentation. And we will see everybody in a week.
Thanks, everybody.
Take care.
Bye, everyone. Great discussion. Thank you. Thank you, Graeme, for your presentation.